Well, I don't know about this sugar high stuff. I'm anticipating some pretty tough questions based on that. But at least you'll be able to stay awake with all that sugar. Good morning, fellow ICLers and fellow taxpayers. At least I presume you're paying taxes. So Mark and I today will be talking about some of the key features of the Tax Cuts and Jobs Act and some of the implications of that act, some of the impacts of that act. We also will find some time to put this all in perspective, to give some context, and to talk about both taxes and expenditures in this country over time, and our taxes and expenditures as compared with the taxes and expenditures around the world. And then finally, we'll say some overall things about our whole U.S. tax system. So when we talk about features, this act is terribly complicated. I mean, it's long, and it's the first piece of major tax legislation since 1986. So we're not going to be able to cover all the features, and if you're especially interested in, say, the tax break that citrus growers will be getting, you'll have to ask Mark about that, because when we talk about, so we're going to be selective, and we'll try to pick features that are quantitatively important in terms of impacts on the debt, in terms of impacts on the distribution of income and wealth, and impacts on the economy, of course, too. When we talk about impacts, once again, it's complex. And so we're going to be relying heavily upon the analyses of others, people with much larger computers than we have, and larger staff as well. Our staff was Gwen Ellen Anderson, who helped us with some of the slides. And I do want to say, she's not in any way to be blamed for the remaining shortcomings, which will surely be there. Even though we want to, in terms of impacts, we want to talk about, we want to be drawing on nonpartisan, impartial analysts whenever possible, and two of those will be the Congressional Budget Office, established in the 70s, and the Joint Committee on Taxation established much earlier. And both those two entities are charged with trying to help Congress understand some of the consequences and implications of the acts that are before, the bills that are before them. But while we want to be analytical and objective, I want to start with some political commentary, some one-line analyses, if you will. I call them analyses. So here's one, and I'm going to ask you who you think is the author or the speaker of this particular. Pardon? Any guesses? He does like superlatives, doesn't he? Okay, here's a, whoops. Oh, I'm going too fast here. The more it's in sunlight, the more it stinks. Okay, the little tip for you here, who do you suppose that is? Chuck Schumer. If we can't sell this to the American people, we ought to go into another line of work. Good. Who's that? McConnell. And then we have insulting crumbs. They give working families are meager and temporary. The tax breaks for corporate. Who? Nancy Pelosi. I think you're pretty much 100% on these. How about this one? I think we all know who said that and where he said it. That's our president again. I think maybe one of the more famous tax quotes is this one. In this world, nothing is certain but death and taxes. And it's kind of interesting that Benjamin Franklin said this, because in 1789, when he made that comment, up through the next century and beyond, taxes were pretty small. You can see they're running about 3% of GDP. I'm going to use the words GDP and national income and national output all interchangeably. I'll show a slide that has some earlier information on it, but I want you to see several things about this slide. One, it shows how small government really was up until World War I, both in terms of taxes and in terms of spending. Another thing you can see is that we get some spikes in there when we have World War I and II. And we get some other little blips that we could identify. One that's perhaps of some interest is what's happening to receipts and taxes during the Great Depression. Really isn't as much as I would have figured, but most of that, most of those impacts are what we call automatic stabilizers. So this is really before Keynes wrote his famous The General Theory. And what happens when we have a downturn is we earn less and we pay less in taxes. And we also draw more unemployment insurance and benefit from other safety net programs. So we tend to have a gap between spending and taxes when we're in a downturn. And you can certainly see fairly significant gap there in the 30s. Another thing you can see in this chart is that there's a general upward trend. And this is pretty typical. When countries become more affluent, they want their governments to provide public goods and services that complement their private goods and services. I mean, if you're going to have a car, you have to have some roads to drive it on. If you're going to fly in airplanes, you need all the infrastructure and the personnel that's associated with doing that. And so we do see an upward drift over time, and we see that wealthier countries tend to have higher spending and higher taxes as shares of GDP. One thing that I hope you've already noticed is that the blue line doesn't get above the brown line very often. And so what that really says is that we're running deficits almost every year. And when you run deficits, you have to finance that. And so you sell bonds, and the national debt, the federal debt, goes up. So let's take a peek at what debt looks like relative to GDP. And this takes us back to I don't know if you can see that, yeah, 1790, again about the time of Franklin, and we're in the midst of paying off the Revolutionary War debt. And we do pay it off, and then comes the Civil War, and spending again spikes, and then we pretty much pay it off. And then we hit World War I, and we get another spike. Pay it off some, but not so much anymore. And again, overall, you can see that the debt, at least in the last century, has been climbing. Might ask, well, what's going to happen in the future? And of course, nobody knows. But this is this graph is drawn from the Brookings Institution, recent article, really talking about you and me, the aging of our population and what it means for federal finance. And what it means, of course, is that there will be more spending for Medicare and Social Security, and there will be less earned because we're going to be not making the big check. We're going to be living off dividends and interest and Social Security and so forth. So what we just did in the past month or two, when we enacted that bill, is we flattened out the revenue line. And what we did last week, when the Senate reached its budget deal, and we now have the president's recommended budget, we don't know how much of it will become reality, we shifted the slope upward on the blue line. And of course that means more deficit and more debt. Let's see how we look relative to other countries. Now these are the OECD countries, Organization of Economic Cooperation and Development. These countries tend to be high income, democratic, market-based economies. And so we've got 35 countries here. And here's where the US is. Our taxes as a share of GDP is 4th of the 35 countries. We're a very low tax country relative to the countries, the Norways of the world that we'd like to compare ourselves with. Now, how about expenditures? Do we have a lot of spending relative to GDP? GDP? Is our public sector big? Well, here we have a picture of that. So we're about 9th or 2, 4, 6, 8 or 9 among the 35 countries. Again, our public sector is not very large relative to the countries that we typically compare ourselves with. When we go to debt, here's debt as a percentage of GDP. That country on the far right is Japan, by the way. And of course, they're where we really came to understand this aging of the population issue. Here we are. And actually, I missed it a bit because that's France. We're really one to the right of there. So finally, we're up there with the leaders in terms of debt as a share of GDP. Not necessarily something that we seek. I'm going to turn things over to Mark, and he's going to talk about our U.S. tax system, and then we'll see where we are relative to the hour.
First of all, Tom and I want you to understand we are not accountants. So if you have any specific tax questions, don't ask us. Second of all, keep in mind that as far as economists are concerned, that President Truman once said he wanted to have a one-handed economic advisor. And the reason for that was because every time he asked a question, the answer would be blah, 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 blah on the one hand, but blah, blah, blah on the other hand. So that's why Truman wanted a one-handed economist. And someone else once said if you took all the economists in the world and laid them end to end, you'd never reach a single conclusion. But here we are to try and reach some conclusions. And my moment now is to just sort of walk through some of the basic tax concepts before we look at the specifics of the particular act that is calling us together today. One of the things that in Tom's wonderful graphs about revenue and expenditure that I just wanted to say is important to think about. It wasn't that long ago when we actually were in balance. In probably the 1990s, and then the diversion started again, and here we are. So it's not something that is that far away. And I think at one point the politicians were saying they were projecting surpluses for as far as the eye could see. Well, I guess the eye didn't see very far because here we are. Okay, so what are the major elements in our tax system? Well, first and foremost, there's the personal income tax. And that was not something that we had in the US until 1913, when there was a constitutional amendment allowing Congress to do that. And as far as personal income tax is concerned, some states have them and some states don't. We in Oregon have the pleasure of living in a state that has a personal income tax, but going down the list, has no sales tax. And there are philosophical reasons for that, which I'll mention in a little bit. Whereas if you go north of us to the state of Washington, it's just the opposite. The state of Washington has a sales tax, but it does not have an income tax. In Oregon, local communities have the option of putting on a sales tax, but very few of them do. So we have an income tax, and the federal government, of course, has an income tax, and the law that we're going to talk about is focusing in on the federal income tax brackets and rates before last year and now this year, and we'll get to those details. And of course, there's business taxes, and business taxes can be on the profitability of corporations, or they can be other kinds of business taxes. One of the most interesting ones that has come up in this whole discussion with regard to corporate taxes is the corporate profits that are held by large corporations overseas, that there is a desire for those profits to return home. And so what has happened in that is that there is a special provision in the last tax law which allows companies to bring those profits home at a much lower profit rate than even the lower corporate tax rate that will be in effect right now. So again, we'll talk more about that later. And then there are payroll taxes, Social Security and others. Sales taxes, and I want to make a comment about the state of Oregon and its ability to raise revenues. Since we only have an income tax, the income tax rate is, as we all know, is relatively high. It can get up to close to 10% very, very quickly on the margin. And it also, what happens when you have a high tax rate in a state, then people find ways to avoid paying taxes, so-called under-the-table kinds of transactions. And in addition to that, there is also the fact that we have in our state a fair number of undocumented workers who don't pay income tax either, and they also don't pay sales taxes. So the revenue base of our state is undernourished, in my opinion. But remember what I said about economists, we can have other opinions along the way as well. But I think the revenue base in Oregon is undernourished because of the way we rely exclusively on the payroll, the income tax. Okay, the sales tax is one that many people philosophically don't like because they consider it to be regressive. And what regressive means is that it takes a larger bite for people from lower income groups than people in higher income groups. And that's the philosophical reason why Oregon politically has stayed with the income tax, where you can tax people at higher incomes at a higher rate. Now, in addition to those taxes, there are other taxes that you come across. There are taxes on specific items. So a specific item is what we generally call an excise tax. And when you go to put gasoline in your car, unless you're Peter, who never puts gasoline in his car, and I think Cassie and David perhaps are in that ballpark right now, but most of us put gas in our car, and there's a federal excise tax as far as that's concerned. And there can be other specific taxes as well. And finally, there is the good old property tax, and the property tax would be on based on the value of the assets you have. And within Oregon and many other states, even though property values have been going up, there have been laws that restrict the addition to property taxes based upon a certain number. It could be 3% per year, even though property values might be going up 6, 7, or 8, or 10% a year. The property tax and income tax categories are important in the current new tax law, because as we shall see, there are limitations on how much of those taxes that you can deduct before you start paying federal income taxes. So keep that in mind as we go along. And certain states that are high income taxes and have very high value properties will find that their residents don't benefit as much as people living in other states, if that makes any sense. And I guess the last couple of comments I wanted to make. There are other bases for revenue. Historically, import duties and tariffs were a way that governments would raise money when goods were coming across the border, and we still collect some, but very, very little, because trade liberalization from because of the OECD and other WTO and other kinds of alphabet soup organizations since the end of World War II. NAFTA is another one. We collect very, very little as far as that's concerned. And finally, I do want to make one comment following up on one of Tom's tables where he showed that the U.S. Collects a smaller proportion of its GDP than most of the other OECD countries. That's a fair statement? And one of the reasons for that is that in the other OECD countries of our level of economic development, Canada, for example, or France or the UK, is that they have, at the national level, a variation of a sales tax. And that's called the value-added tax, usually. And if you've ever traveled in Canada, when you go to pay your bill, if you haven't been surprised recently, you probably must have been surprised initially, because you have the provincial VAT and you have the national VAT, and it can add 18–20% above whatever the price is that you're paying for. So those other countries may have corporate tax rates that are lower than ours, but they make up the revenue by having taxes coming in at a different level. So if any of that makes any sense, I will have succeeded. But again, these are the major categories, and these are the things you have to think about with regard to the federal tax law. So now I think it's time for Tom to get up from snoozing and go for the next round.
That's okay.
Oh. And before he does, I just want to thank Sharon Johnson and Arthur Hill. Yesterday's Wall Street, if you really get turned on to this stuff, yesterday's Wall Street Journal had a special section called The New Tax Law. And here it is, and I promised Arthur I'd return it to you, so here, don't worry. And also, the Statesman recently has been following a story about the consequences of the tax law on Oregon revenue and the attempt by the legislature to try to offset some of those consequences. And there was just a story about that in yesterday's Statesman, and that'll be an ongoing story as well. So anyhow, keep that in mind if you need interesting evening reading.
I might just mention the Statesman Journal article. I don't know if any of you read it, but the contention was that this is so confusing that they couldn't even explain it to the reporter. And we're going to get to that later on, and I'll try to take a stab at it. I don't think it's really that confusing. It may be, you know, a lot of this stuff is not real easy to get your head around. So let's talk a little bit about the act itself. When the Trump administration came into office, they began talking about tax reform and basically tax cuts. And I think my sense is that it was sold, one, to simplify the code, that is to reform taxes. Two, it was sold to do something for the middle class. And three, it was sold as something to help U.S. corporations be competitive internationally. Now, when we talk about simplifying the code, you know, I think all these are admirable goals. I mean, I think we should have been doing something for the middle class. I think we should have made an effort to simplify the code, and I certainly want our corporations to be competitive. So let's take a look here at the code. Now, this table shows that in 1913, when, as Mark pointed out, we began to utilize the income tax, the code was 400 pages long. By 1939, it was only 504 pages. And now in 2013, I'm not going to read through the rest of them, but in 2013, it's 73,954 pages. So there's good grounds to simplify. I've asked Mark to look over the code so he can answer any questions that you might have about it. And I'm not sure if he's finished that job yet or not. But, so, you know, I think the part we got right, I don't think we really did much in simplification. That's the sense I get in reading about this new act. That yes, there were some loopholes closed, but there were lots of other ones added. For example, citrus tree growers. I mean, I don't think we did much for the middle class, and we're going to get to that before we're through today. I think we did a good deal to make U.S. businesses more competitive internationally, and again, we'll be talking about that. I'm going to begin by talking about the personal income tax, and I'm not going to deal with, Mark is going to address the issue of how we changed the concept of taxable income, that we added some things and subtracted some things, like the child tax credit and like the ending of personal exemptions and so forth. Mark's going to discuss that. I want to talk a little bit about the rates. Okay. So this is what I grant you this is pretty hard to get a handle on, but I want to just point out a couple things about it. It shows the old brackets on the left and the new brackets on the right. And you can see that the first bracket wasn't changed at all. If you were earning taxable income between $0 and $9,525, you still pay 10% on that income, just as you did under the old act. By the way, none of this happens this year. It's going to be, that is when we pay taxes in April, we'll be using the old brackets. And when we pay taxes the following April, we'll be using the new brackets. Now, you can see that the bracket remained the same in the second, in the second of the two brackets, from 9526 to 38700, but the rate went down. And so this is kind of typical of what's going on here. People are paying lower marginal tax rates than they used to. That is, under the new act, they'll be paying lower. And if you go to the bottom, look at the last entry. Most of us don't really have a personal interest in this last line, but if you were earning $426 and $430,000, you were paying a marginal tax rate on everything over that number at 39.6%. Now, the bracket, lower limit of the bracket has been raised. It's only over $500,000, and the rate is down. Now, when I look at these things, I don't see dramatic changes, but I know they're there because it's going to mean $1.5 trillion to the national debt over the next 10-year period. The CBO and the Joint Committee on Taxation look ahead 10 years, and so we will be collecting just through these rates $1.5 trillion less than we would have collected under the old bracket. So it is needless to say significant. Another thing that's been mentioned often in the press is that these new brackets are to be sunsetted, that is, eliminated, and we go back to the old brackets in 2025. And you probably also seen, because it's almost always in the same sentence, that the corporate tax rates are not going back to the old rates. They're staying at their new lower levels. Now, I think probably all of you know this, but I'm just going to mention. Let's take the 500,000 plus people. They're paying 37% on everything over that. They're only paying 35% on the 200,000 to 500,000 package of income. They're only paying 32% on the $157,501 to $200,000 packet. So averages, if we look at the average, which would really be a weighted average of these marginals, the averages will be less than the marginals. Now, why do we care about this? Well, it's the marginal rates which tell us about behavior. If your rate is, say, 25%, that's the rate that you're going to take into account when you decide to work a little more or when you decide to save a little more. The average, on the other hand, tells us about burden. You know, how much am I really having to shoulder out of the total federal package? And I can compare my average with people's averages that earn a different amount of income or with a corporation or whatever. So both averages and marginals are important, but really for different reasons. And as I mentioned earlier, we can't just look at this and determine what's going to happen to income or what's going to happen to taxes, because we're also changing the whole concept of taxable income. And Mark will be clarifying some of that in a moment. I'm going to turn to business taxes, and I'll go back to this slide. I'm going to talk about the corporate tax rate, taxing overseas profits, pass-through tax treatment, and investment expensing. In my view, these topics are complicated and kind of boring. And so I don't want to get into the weeds. I noticed Charlene using that term last week, and one of our speakers as well. I kind of like it. I'm not going to get into the weeds on all these issues because they're just too complicated. But I do want to say some general things about each one of them. The corporate tax rate is indeed being lowered, and we don't need to worry so much about the different brackets here because almost everyone falls into the same bracket. Let me see here. I gotta get this. Now here we see corporate tax rates again for the OECD countries, and that country on the far right is us. So indeed, in 2014, and I'm sure it would be true before we passed the Tax Cuts and Jobs Act, we had the highest marginal corporate tax rate of any of these 35 countries. Now, we have also, it's hard to compare these things because we've got lots of deductions and exemptions and tax deferrals and so forth that kind of muddy the waters when we're looking across different countries. But this slide, by the way, is drawn from President Obama's 2015 Economic Report of the President. And in that report, in this chapter 5, they are making a case for lowering the marginal tax rate from 35, not down as far as the Congress did lower it, but to 28%. So they were talking about a significant cut in this rate too. I think most economists are of a mind that it makes sense for our marginal tax rates on corporations to be lower. On the other hand, corporations are doing pretty well. Yeah, you did. Peter says, well, on the one hand this, and on the other hand that. This rate takes us down below China, Japan, France, Germany, and lots of other countries. So maybe, and by the way, Obama, when he wanted to lower the rate, he wanted to pay for it by closing some of these loopholes so that the corporations would still be paying the same tax, but they'd just be paying it in a different way. And that's really what reform is all about, by the way, coming back to that term. Again, it's to simplify the code, close loopholes, and lower rates. And I think this slide shows that maybe it did make sense to lower the rates, not necessarily everything else that we did. Let's see, let's go back again and look at taxing overseas profits. Oh boy. Okay, I got into a couple of little weeds here, but overseas profits, right? Well, that is until we pass the new tax code. Corporations, U.S. corporations pay taxes on their worldwide profits. Most countries around the world only collect taxes on profits earned inside their borders. So what we are really doing is we're making a move toward what the rest of the world has been doing. It's not that simple, but that's basically what we're doing. We're, from this point forward, only going to tax profits that are earned inside the U.S. rather than profits that are earned elsewhere. And as Mark pointed out a moment ago, we've got corporations with billions of dollars of profits held abroad on which no taxes have been paid. So when we passed this new tax code, that is when we decided not to tax earnings that are earned in other countries, it would pave the way for businesses being able to repatriate these profits at zero tax. So at least Congress said, no, we're not doing that. We will give you, as he mentioned a moment ago, a one-time mandatory repatriation, and the rates will be very favorable. So corporations bring those profits back, and I don't know how this is going to look when we look at the books in a year or two, whether we will attribute all this to the Trump administration and the Congress, that look what they've done, they brought all this money back. And I think there's a good side, Peter. On the one hand this, and on the other hand that. There may be something to be said for that. But I think we have to be careful about judging the whole package just on that one point. So going back again to the listing here, pass-through tax treatments. Again, got to get into the weeds a little bit here, but and this is something I didn't know. Right now, only 5% of U.S. businesses are corporations. I would have thought it was much larger than that. And they account for about half of all the business income earned in the country. And that wasn't true 35 years ago. The numbers, the share of corporations as a share of all businesses would have been more like 50 or 60%. Now it's 5%. So there are lots of entities. What are they? They're sole proprietorships, they're partnerships, they're so-called S corporations, limited liability partnership corporations, and those entities don't pay tax as a business. And this is where the term pass-through comes. The profits are passed through, and it's the owners that pay those taxes based upon their own personal income tax rates. So the problem here is that Congress and the President didn't want to do something for big business without doing something for the little guy, because we think of these as little. They're not all little. Some of them, as I say, they account for 50% of the business income in the country. So Congress, I have a hard time understanding exactly the logic here, but they provided for a 20% reduction right off the top in terms of taxable income. So if a partnership has a taxable income of, say, $500,000, they're only going to be paying taxes on $400,000 rather than $500,000. Now, I guess the part I really don't understand is if this is a good thing, then why do we sunset it, which we're doing? This is going to go away in 5 years. So over the next 5 years, I guess companies have to decide, well, now do I want to reorganize as a pass-through company? If I'm starting a new company, do I want to start it as a pass-through or as a corporation? It seems to me that this creates a lot of confusion. And moreover, when we have different tax rates for different kinds of entities, it creates the possibility of efforts to avoid taxes. All of us do this. We look for the ways that we can minimize our tax burden. And that's what the article in the Statesman Journal was about as well. And so we'll have to see how this all plays out. Okay, going back to the last item I want to take up is investment expensing. and again, this is a bit of weeds here, but no more than I need. When corporations buy tangible assets like computers and machinery, they can take part of this as a deduction of their income tax each year, and they can spread out the cost of this thing over the life of the asset. Actually, it's more favorable than that, but that's the principle. Well, now for the next 5 years, corporations are going to be able to take all of it in the first year. So the year they buy the machine, they can deduct that from their taxable income, if they have any taxable income. So this won't help companies that aren't making a profit. But if you are making a profit, here's an opportunity to deduct it all in the first year. Again, this is going to be sunsetted. So I'm just guessing that firms that are on the border of buying new computers or not are going to get right onto it over the next 5 years when they can accelerate the depreciation by taking it all in the first year. So I don't know how we do it for time. Pardon?
Whenever you're done, I'll go.
Okay, yeah. So we're going to turn it back to Mark, and he's going to decide whether it's time for our break or not.
Is everybody ready for a pop quiz on all these concepts? Okay, what I want to do just in a few minutes is to go over some of the nitty-gritty details of the tax bill. Again, that Wall Street Journal insert yesterday will have much more detail than we'll provide for you, but I think these are important things to point out. First of all, there are limits to the standard and itemized deductions, limits and changes in that. And the bottom line is that fewer people are going to itemize deductions on their income tax because the automatic deduction, the standard deduction, is being raised. Almost double. A couple would be able to have a standard deduction now of $24,000 a year. I think it's either exactly or approximately, and a single person would be half of that. And this has a lot of the charities rather nervous, because people who, like most of us, give to some charities. Some people, it's hard to believe, might say, well, I can't itemize it and get a tax deduction anymore, then I'm not going to do it. So that's something that may unfold as far as that's concerned. The other interesting thing about the new law is that in the itemized deductions, there are limits on how much you can deduct from your federal income tax through using state and local taxes, state and local taxes, SALT, the SALT taxes, and that limit is around $10,000 a year, so that if you live in a very high tax state, like Oregon, with its personal income tax, you will not be able, even if you wanted to go above the standard deduction, you will not be able to do so. So keep that in mind. That's interesting to see how that plays out. Many of the states now are looking for creative ways to work around these federal kinds of new regulations, and we'll see how they work out. And if they do work out, they'll probably be challenged by the government and things like that. So it's an ongoing saga as far as that's concerned. So that's the word on the standard versus itemized deductions. Yes, more, but limitations. The other interesting footnote in all this is that, and this is important for most of us in this room, in addition to the standard deduction, there is a an additional deduction for people 65 years old or 65 or over. And that comes out to $1,600 for a single person and $2,600 for a couple. Why they didn't double it, I don't know, but that's what the numbers are. So keep that in mind if you do your own taxes, but most of us either use an accountant or they use TurboTax, and it's probably already built into the next round of TurboTax anyway. There's that. The mortgage interest deduction limits are still there. There was some attempt earlier to wipe them out completely, but the housing industry wasn't and banking people weren't very happy about that. So it's still there, but there are, again, limits. The mortgage interest deduction has a ceiling on the value of the property that you can write off the interest on, and that is, I think, $775,000, somewhere around that. And again, living in Salem, Oregon, that doesn't sound like something to worry about, but if you live in large cities, back east or Connecticut or elsewhere, and maybe even some places in Portland, your property values might be above $775,000, and if you took out a loan, you would be limited to how much you could deduct from your federal taxes, okay? So that's that change. The personal exemption is gone, and the reason for that is the standard deduction has been doubled, so it doesn't matter how many people you have in your household, with the exception of the child tax credit. And that is a bottom line tax credit, which currently in the old law was $1,000, and under the new law it becomes $2,000. So if you do have children at home, your bottom line, after you've calculated all the other deductions, your bottom line per child now is $2,000 less for your tax liability for one child, and then multiply it by the number of children. And then the last thing I wanted to mention is the estate tax exemption. That is also being doubled, and I'm sure most of you will be happy to know that as a single individual at the federal level, you are exempt from your estate being taxed up to $11 million under the new law. I can see how happy everyone is. And for a married couple, it doubles, about $22 million. So keep that in mind as you are thinking about the future. At any rate, these are the major features. There are lots of other details that either we don't have time to talk about or we have no knowledge about, given the number of pages that Tom pointed out that are in these new tax laws. This might be a good moment to pause to see if there are any questions or comments, and then we should take a break and then come back, because what we want to do then, as one-handed economists, we want to talk about, what are the consequences of all the things we've been talking about in the second part of this session. Okay, so Q&A time.
Dave here. On the standard versus the itemized deduction, we just went to the tax guy yesterday. So the itemized part won't be applied to the federal tax, but to Oregon state tax, you can still itemize for 2018. So that's just a little addendum to your conversation there.
Yeah, states still have their own independence as far as that's concerned. Similarly, the Oregon estate tax exemption is much lower than the federal tax exemption is. So you're absolutely right on that.
This is Barbara over here. You pointed out the difference between Washington and Oregon, but you didn't point out the difference between Oregon and California. California has both state tax, which is not cheap, and 9% and upwards sales tax. So we moved here in 1949, and ever since then I remember them trying to get a sales tax in and eliminate the property tax, but that doesn't always work that way.
Ain't politics wonderful? Yeah, basically it boils down to what your elected political leaders do.
I was just going to say, yep, Barbara, you're talking about Proposition 13, is that right?
No,
Oh,
I'm talking about,
okay. Well, I just wondered because it created a lot of confusion, needless to say. And I know some of you probably lived through that, but it certainly impacted whether you wanted to sell your home or whether you were more likely to be less mobile. Yeah.
Jeanette, can you say anything about how this has affected charitable deductions?
What kind of deductions?
I'm sorry, what was the question?
How it has affected charitable deductions. You talked about mortgage, but...
Yeah, my point with regard to that is that under the new tax regime, fewer and fewer people are going to file with itemized deductions because the standard deduction is much higher. So if you have given to charities and you continue to give to charities, unless it goes above the $24,000 for a couple or $12,000 for an individual, you still wouldn't itemize that. You wouldn't get any tax benefit from it, is what I'm saying. Whereas now, you basically can get a tax benefit almost dollar for dollar with charitable deductions. And that's why I think it's something people haven't thought about, but may have consequences.
I have a question about the CBO, or if I were to compare it, I think of it like if there were a fire department at Pompeii, it would be the CBO that ran it. These projections have proven wrong in many cases in previous years, mainly due to static kind of computations. So therefore, how reliable do you think we can take any estimate from the CBO going forward?
Well, I've read also that they tended to underestimate the impacts, and part of it is because their scoring, as they call it, doesn't always include the macroeconomic impacts. In other words, this tax bill is going to increase the growth rate of the economy. Not very much, as most people are saying, but that'll lead to more taxes being collected. So you have a tax cut, and then that leads to growth, which means more income, which means more taxes. In the extreme case, I think Gary Cohn, the chairman of the Council of Economic Advisors, suggested that this tax cut may pay for itself. And nobody else seems to take that view. But I guess my feeling about the CBO and the Joint Committee on Taxation is that they're the best thing we have. I mean, otherwise we're having to deal with cable news and a lot of other numbers that are coming from who knows where. So at least we have, I'm not in any sense claiming that they're perfect, and I don't think they are either, but I don't think we have any other choice.
Jenks, up here. A number of years ago, I read that the three main taxes, income, sales, property, combined, ranking the states, that Oregon fell right smack in the middle, even though we don't have the sales tax. And I'm wondering if that is still true.
I could have answered that question about 20 years ago when I was teaching state and local public finance, but I can't now.
Okay, and then the other side of that is, with this estate tax, I croak, my kids don't have to pay any money, we don't have an $11 million estate. So are they going to get off scot-free? Is that right?
You're asking about the estate tax now? Well, yeah, basically. I mean, people who are making more than 11, or who have estates of more than $11 million, will have to pay a tax, but the others, no. Well, okay, we may have a state. Yeah, we're really focusing on the federal Tax Cuts and Jobs Act here. Yeah.
If you're confused, so are we.
Hi, this is Joan. My question is about the effect of tax policy on actions, particularly by individuals. And I probably, run in the wrong circles. I don't know anybody who has refused a raise or a job on the grounds that it would put them into a higher marginal tax bracket on the personal income tax. Are there studies that show that that actually happens on an individual level? I mean, I can understand it on a corporate level, I guess, but on an individual level, does that happen?
I always worry about a question from somebody named Joan Robinson because she was a famous British economist.
Yeah, but she's dead and I'm not.
I don't, I think we all feel that way. We don't know anybody who did that. But yes, there are studies that show people do respond at the margin, overall. And so, yeah, when I mentioned that marginal tax rates have to do with behavior, that's pretty much conventional wisdom, and it's based on empirical analysis. Yeah.
This is Ken. I realize, or I think, they put this whole tax code through pretty quickly, and of course there's thousands and thousands of pages that have been added, and everybody's trying to figure out the impact. So I'm pretty sure that the people in Congress don't understand the impact. Does anybody? Is there an expert that can tell us what's going to happen, or are we in for at least 24 months of experiment here to find out what's happening?
That's a rhetorical question.
I think it'll be more than 24 months because people are going to be trying all kinds of things based upon. The New York Times had an article recently, and the headlines was, "Let the hunt for loopholes begin." And what we're going to see happening is, I don't think I'm going to try to recharacterize my Social Security check as a pass-through business, but there are going to be a lot of folks who are going to be trying a lot of things, and a lot of corporations who are going to be trying a lot of things, and we won't know. We'll have to have rules and regulations promulgated, as the term is used. We're going to. I don't know how long it'll be. So I think the answer is, yeah, nobody knows.
Just a footnote, and I think we probably ought to take a break after that, that we did not mention because we were talking about taxes, is this law had a provision that took away the mandate for the Affordable Care Act. And what that has to do with the federal tax system is of course, mysterious, but that's the way politics is made. But that was in the law, and that does have consequences as well, both on a humane level and on a state budget level, and for other kinds of provisions as well. So I think this is probably a good time to take a 10-minute break, and then when we come back we'll talk more about the probable but not certain consequences of the new regime. Okay, just a footnote, a couple of people have been focusing in on this question of the anticipated increase in the federal deficit over the current one if we didn't have this tax cut. And I wanted to just let people know of a concept called the cyclical balanced budget that starts with a C, not an S. It's a concept that economists have, which essentially says that over the course of a business cycle, that the overall federal budget should be balanced. That is, when the economy has a high rate of unemployment, then you should run at a deficit to try to stimulate economic activity. And when an economy is operating on all cylinders, low rates of unemployment, the revenue coming in should be more than the expenditures. And so one of the concerns that economists have, either on the one hand or on the other hand these days, is that the current situation for the economy is pretty good. It may not be perfect, but Oregon has its lowest recorded unemployment rate in decades. Same true at the national level. What's it, about a little over 4%, Tom? Something like that. We're beginning to see signs of inflation. The CPI that came out yesterday was on an annual basis of about 6% if it maintained itself monthly. So the economy is doing reasonably well, and one wonders whether it's wise, when the economy is doing so well, to then put more fuel onto the overall economic activity. Tom mentioned the write-off, the rapid write-off on business investment, for example, or having higher consumer spending income based upon those tables that Tom put up before. With the lower tax rates, people might go out and spend more money at a time when the economy is already doing well. And one of the consequences of all this is not only would the federal deficit go up based upon what we know, unless there was such dramatic economic growth that the revenue came pouring in, but it doesn't seem that way, then the consequences might not be all that good right now. Even if you like the concept of the tax cut, this might not be the time to do it or the way that it should be done. But at any rate, if you look at the major categories to think about with respect to all of this, these are the ones that are up there now, and we'll have some charts to give you some projections of what some of the experts think. First of all, there is the question of income distribution. Which groups on the income spectrum gain the most, and by what percentage, and things like that. Second of all, there's the question of wealth. Wealth is not income, but it's the value of the assets you accumulated over a lifetime. And does that have implications for the distribution of wealth? Tom mentioned the whole issue of economic growth. The people that are in favor of this tax regime say it's going to stimulate economic growth. And it may be that 9 of 10 economists surveyed say that it will stimulate economic growth, but if you drill down on how much economic growth, it's very, very small, given the fact that we are operating at such a full employment level. So that's something to think about. The federal debt is something we've talked about and will continue to talk about. I don't think most of us would like the federal debt to reach a level of Japan, all the way off to the right there in the chart that Tom showed earlier on, where the federal debt gets so high that it could be a little unmanageable and might have some implications for the international value of the US dollar and our ability to travel abroad or to afford it, and little things like that. And then finally, this is really, Ken's comment about this is an evolving kind of legislation. The states are trying to deal, or first of all, trying to understand the consequences of this new tax law. The whole concept of 20% tax exemption for passive pass-through income has consequences for state revenue. It's complicated, but it really does. Other states are trying to figure out ways to help people offset some of the consequences. Comment came up this morning, this is not a state response, but I made the comment about charitable contributions. One way that if you do like to itemize, that people might think about, I'm not recommending anything, but instead of giving contributions every year, bundle it and do it every 2 years, and then you'll have double the amount of contributions when you do it, and then the off year just take the standard deduction. So this is an ongoing saga, and now I'll turn the saga over to Tom.
Well, I'll follow up on a couple of the things that Mark said. I don't know if we'll ever get back to our outline or not, but not only is this an awkward time to be cutting taxes in a significant way, on the other hand, it's also an awkward time to be increasing spending, as we witnessed last week when the Senate reached its budget deal. So both of these things are going to be adding to the deficit and therefore the debt. And on that point, Mark mentioned the international value of the dollar. Another issue that comes up is when our debt is larger, we've got to finance that. We've got to pay interest on that. And so that interest cost squeezes out some other things that you and I might think are worthwhile. So just a couple of points to keep in mind. I'm going to say a few words about forecasting, and I think it fits with what Ken raised, and also the comment on the CBO. Let's see here. Okay. Well, you can see from my selection of these quotes that I share your concerns. You know, Galbraith, as always, is a lot of fun. I don't know if any of you have ever read his book, The Great Crash, but he's writing about the Depression, and in that book he quotes a famous economist who said that in 1929 he thought the economy had reached a permanently high plateau, and so his name was Fisher. And Galbraith says, thankfully, Professor Fisher is remembered for other contributions. But you can see that a lot of people have reservations about forecasting. I think the last one is the one that is meaningful for me. And it's in part the way I responded to the CBO thing. I think it would be rash of us to enact legislation or vote for people with no idea of the consequences. And so I think we do the best we can. Actually, Silver, I don't know if you followed his work, but he's had a remarkable record in predicting elections and in predicting how valuable baseball players were going to be, and what he's sort of covered the waterfront with. I'm trying to remember the name of his book. It's Noise and something or other. Anyway, good book to read. And I think he's right. We really need to do our very best with forecasting. So, Mark, I think you're going to begin with the first couple. Okay. Income and wealth.
We're getting good exercise going up and down. Okay, this is just a look at the share of federal tax revenue and where the money comes from. And I think one of the things that jumps out there is how minor corporate tax revenue has been and is and probably will be, regardless of what the rates are. As far as federal revenue is concerned, it's direct taxes on income, and it's various kinds of payroll taxes that are going to be the major thing. And the implications for the tax law would be what the rates are with respect to all of that, and then you run the numbers through. So I think that's fairly obvious. This is a chart that looks at the federal taxes and expenditures projected over the period of the new tax regime that we've been talking about. And what's interesting here is that if you look at the yellow highlighted area, these areas actually don't benefit from the tax regime at all. It is you need to reach a certain level before you see the minus signs showing up there with respect to your tax liability going down, okay? So if you were talking about the consequences of income distribution as far as this tax law is concerned, the conclusion for this is that the distribution of income will be less equal after this as a consequence than it was before. And exactly where you would stand on that depends on your gross income and what your benefit would be, okay? Let's see what the next one looks like. You want to take this one, Tom?
I think we can skip that one.
We can skip that one, all right. All right. These are the distribution of benefits. If you look at the left-hand column, it's the distribution of benefits based upon an income category. And once again, 65% of the dollar value of the benefits from this comes for taxpayers with incomes over 150,000, just to round it off. But if you're under 25,000, as Tom's earlier chart mentioned, there's virtually no benefit whatsoever. So you have to earn more to get a benefit with respect to that. And then the right-hand chart looks at the fifth quartile in terms of where the distribution of benefits comes, and what those numbers show is that the higher your income is, the more dollar values of tax deductions come from that, if that makes any sense. Okay, so in other words, the top 20%, the top 1% of the fifth quartile capture 20% of the overall dollars of tax reductions for that. So once again, as far as distribution is concerned, that seems pretty clear what the consequences are as far as income distribution. And this is a breakdown of where the benefits would be based upon the types of taxpayers or types of taxes that we've been talking about this morning. So we have the corporations would be 37% of the net benefits. Individuals, a little less, 31%. And the pass-through, 26%. That's very significant, as Tom mentioned. And then the reduction in the estate taxes would result in some lower taxes there. But again, only 6% of the total overall as a consequences of that bill. So I think that's fairly clear. Whether you like it or not, that seems to be the way it's going to work out. What did I do? It's time.
Through the slides.
Oh, well, it's time for you to.
Say a word or two about wealth.
Well, why don't you? You have a wealth of words to talk about.
Well, of course, income is the basis of wealth, and so we ought to see a connection between a less equal distribution of income and a less equal distribution of wealth. But we can even compound it, because the main beneficiaries, the main beneficiaries of the corporate enhancement will be people who earn dividends and capital gains, and that's not typically the low-income people. And also, the people who are going to benefit from this doubling of the estate tax, there weren't a lot of people here who suggested that that was going to impact them, but it is going to impact some of those Mar-a-Lago people. The other two things that we want to talk about, the other three things, are what does this do to the debt? What does it do to the overall growth of the economy? And what are some of the differences in state views on this whole thing? So along the way, Mark mentioned if we got two economists in a room, we get three opinions, or if we laid them all end to end, they wouldn't reach a conclusion. Actually, economists are speaking with pretty much one voice on this issue. The University of Chicago, which is not noted as a left-wing entity, especially the economics department and the business school, have a survey that they do of economists, of super big-time economists, maybe 40 or 50 people in the country. And they polled this group of economists in November of last year, so the tax bill was not concluded, but it was still looking pretty much as it finally came out. And I want to read to you the questions. There are two questions. One deals with the debt and one deals with the growth in the economy. And the first question was, if the U.S. enacts a tax bill similar to those currently moving through the House and Senate, and assuming no other changes in tax or spending policy, U.S. GDP will be substantially higher a decade from now than under the status quo. So that was the question. Well, 19% strongly disagreed, 33% disagreed, and 36% were uncertain. That doesn't leave very many who really thought that GDP was going to grow significantly as a consequence of this. Gary Cohn wasn't part of the survey, I guess. So the second question is, and by the way, there's a weasel word in there, substantially. You know, I don't know what that means, but here we've got a pretty large group of economists spread across the political spectrum reaching the same kind of conclusions. The second question was, if the U.S. enacts a tax bill similar to those currently moving through the House and Senate, and assuming no other changes in tax or spending policy, the U.S. debt to GDP ratio, which we've been talking quite a bit about in here, will be substantially higher a decade from now than under the status quo. 45% strongly agreed, 43% agreed, and I don't know what's going on with this table because they only show 2% more, and that doesn't add up to 100%. So maybe we had some people who didn't respond. But again, the vast majority of people think that this act is going to substantially, again a weasel word, increase the debt to GDP ratio. Well, we've mentioned the CBO, the Congressional Budget Office, and the Joint Committee on Taxation, and we all acknowledge that. Hey, I'm sitting here thinking they got the bill just days before they issued their report. It's pretty tricky. I mean, in fact, here's another point that I found kind of interesting. I'm not sure if it's a CBO or the Joint Committee on Taxation. They used 3 different models, and then they weighted these models. Well, that suggests to me, Ken, that they're not absolutely certain about what they're doing. But they're doing their job, and they're doing it as well as they can. And again, I'm with Nate Silver. We go ahead and make our forecasts, and we acknowledge that they're imperfect, and we hope that they're not so imperfect as to be useless. So let me tell you what the CBO and the Joint Committee on Taxation said with regard to economic growth and the debt. As far as economic growth is concerned, they say that over the next 10-year period, GDP will average 0.7% more than it otherwise would have been. In other words, if you took GDP and you figured out what it was going to be in 2025, you would just multiply that by 1.07, and you'd get GDP under the new tax. So it's almost invisible. And then after that, and I should also add that most of the growth, they're averaging this over the 10-year period, most of that happens in the first year before things start sunsetting. And so that by the end, the growth is 0.01%, and may very well reverse in the decades that follow. As far as the debt is concerned, and I'm using both these entities together, although one of them was really responsible for this, and I don't know, can't remember which. As far as the debt is concerned, it's pretty complicated, but there are a bunch of forces at work. First, there's the act itself. Then there are the macroeconomic consequences of the act, and what that means is that this act is going to increase even if by a small amount, GDP over what it would have been. And that will lead to more taxes than we would have collected just looking at the act itself. I know this is confusing, but 3 components. One is, what does the act do? What are the additional impacts of a growing economy on the debt. And then the third is, if the debt's going up, then the interest costs are going up. And that's a consequence too. So they're saying that all that stuff taken together means about $1 trillion added on to the national debt in the 10-year window. Is $1 trillion a lot of money? You know, Everett Dirksen was famous for saying, a billion here, a billion there, pretty soon you're talking real money. Actually, he says he didn't say it, but everybody quotes it, so I'll quote it. Actually, the national debt right now is about $20 trillion, and is expected to go up anyway by another 10 billion in the next decade. So we're really, you know, we're adding to the debt, but we're not adding massively to it. You know, we're really adding kind of $1 trillion onto a base of 30 trillion. But again, as Everett Dirksen says, we are talking real money. Mark? Some stuff you might want to know.
Yeah. One other footnote in this whole discussion, we haven't mentioned the Federal Reserve, the U.S. Central Bank. And one of the things that they did to try to get us out of the terrible financial crisis that we had in 2007 was something called quantitative easing. One of these wonderful expressions. Essentially what that meant was that the Federal Reserve just kept buying U.S. government debt and putting it on their balance sheet. Well, what is the Federal Reserve doing now? Well, they're trying to unload what they have on the balance sheet because the overall economy no longer requires them to just keep on buying federal debt. And so as a consequence of that, in the short term, we're seeing interest rates going up on, particularly on 10-year treasuries and 30-year treasuries. Now, in my opinion, they're not high enough yet to what they should be in a normal market. Because remember the good old days when you can get 5% on a certificate of deposit and not have to worry about things? I think those when America, that's when America was great. And I'd like to see something along those lines happen as well. So we're in that process now, but the comments about the debt need to be also put in the consequence of what the Federal Reserve is going to do in this, and they will probably accelerate the increase in interest rates because of the backing away from quantitative easing. I think we probably ought to just open it up to questions and comments at this point, unless there's something you'd like to add to it, Tom. He's coming.
I'll just make a comment or two. I think the point that Mark just made about what the Federal Reserve might do is right on, and I might even add to it. If the Federal Reserve sees what our fiscal policy is doing, that is our cuts in taxes and our increases in spending, if they see that as likely to lead to more inflation, they're going to put the brakes on. And so that'll reverse a lot of the effects that we're already talking about, Ken. And so who knows, what's going to happen. The other thing that frankly bothers me a bit is, will we see Congress downstream in a few years saying, well, we've got to address the deficit. We did that in 2012 when we probably shouldn't have. And if they decide that we need to do something about the deficit and the debt, I don't see them cutting defense. I mean, maybe they will. It's going to depend on a lot of things, but I get a little worried that this could be used as a means of influencing Social Security or Medicare or other social safety net kinds of programs. So, and again, that further complicates what will be the consequences of all of this, and it's one of the reasons why the CBO is off, is that things don't stay the same. I mean, they're trying to say, what would happen if this tax act was passed and nothing else changed? Well, things do change. And so they're always going to be wrong. Yeah. So should we?
Hello, this is Bob over here. And this goes back to the early part of Mark's presentation. There were comparisons being made between the United States and other countries in the OECD. And what I wanted to know is, were those comparisons looking at all taxes, all spending, or only federal government taxes, spending, and debt? We have a federal system which is not the same as all those other OECD countries.
Yeah, I think, by the way, there was no footnote explaining that, but I'm sure if what you're thinking is it's all spending and all taxes, I think you're correct. Because otherwise, how would you be able to even make these international comparisons? But I don't know. I'm just saying, I think so.
This is Don over here. As you know, sometimes our question policy is very, limits one to try and learn something on a complicated subject like this. You know, I have 14 questions, 7 for each of you, and I'm going to try and characterize it by saying what I really believe this is. I think you've done a nice job of calmly describing the disaster that's about to happen to us. A disaster called trickle-down economics that hasn't worked in the past and hasn't worked around the world. And it's really a cruel hoax on the American people. As you point out, the distribution, how it'll handle the distribution in income. We all know what happens when fewer and fewer people can make a living and can find a job at the lower end. That tax rate changes is the most cruel chart I've seen that we really are taking from the people making $10, $20, $30, $40,000 and transferring it to the rich, expecting some magic to have it trickle down. As I see what's gone on when I've been paying attention the last 30 years, is that we've been fed this line that market's always right and regulation's always wrong. Private is always good, but public is wrong. And the worst thing of all is the taxes that goes to pay for these public programs. We know where the rubber's going to hit the road. It's going to hit the road as you suggested. They're already planning the Medicare cuts, the Social Security cuts, because we've got this massive deficit created by funding the ultra wealthy. So I guess.
I think that's at least 7 or 8. So.
Okay, I guess I should stop then. I've exceeded my quota, but I'd like you to critique my argument.
Yeah. Let me just make a few comments about all this. Someone in the not too distant past probably would have referred to this as voodoo economics. And you remember that expression in the 1990s. Portland has, I think, voodoo donuts, but I'm not sure that'll get through. The other point, the other sort of interesting thing to think about, there is another, you mentioned Joan Robinson, but of that era there was another economist named Joseph A. Schumpeter, if that rings a bell. Capitalism, Socialism, and Democracy was one of his major treatises, and he came up with the concept of creative destruction. And what did he mean by that? Well, what he meant by that, you do go through cycles, economic cycles, where the established order really gets undone, and they are painful and they are dreadful, but you get through them somehow, And when you come out of them, you are in better shape than you were before when you went into them. The problem is a lot of people get hurt along the way when that destruction takes place. But you can see some of that even now in the reporting of corporate profits. American companies, with some exceptions, reporting very good earnings, and they are beating expectations. And part of the reason for that is they went through the horrible times of 2007 and 2008, and they had to do what they needed to do to survive, and the consequences were they emerged in a stronger position as companies than they were before, notwithstanding the people whose lives were disrupted. So it's an ongoing saga, Don, and I don't think this is the end of the economy as we know it, but we certainly have challenges in the future, and let's hope for the best. If you want to.
I think you did a nice job.
Okay, right here, Irene. So I know that the mortgage interest is based on the 10-year bond usually, I think. But when you were getting those really high CD deals, weren't you paying really high interest on loans? So does this kind of offset? And that's my comment, maybe, because I have a question. And that is let me read what I wrote. Are the low-income people still going to get their earned income tax credit? Or is that kicked off of this? If it is, that's a really big loss for the low income.
It's still there.
I'm not sure.
Yeah, as far as I know, it's still there. And in addition to that, there is the doubling of the child tax credit that I mentioned before. As far as the interest rates are concerned, I don't think we want to go back to the 1980s. Remember the 1980s when interest rates were in the double digits and mortgage rates were high and that sort of thing. Somewhere in between the last couple of years where you literally paid a price if you just let your funds, if you had savings, you earn nothing on the savings. And despite what the government has said about the CPI and inflation being under control, go to the grocery store and compare prices, not to mention the size of the boxes of cereal you're getting, where they cut every few ounces here and there. So I think somewhere in between here and there would be best for a normal functioning economy, and that's the one that I think Tom and I would agree would be better. Whether we'll get there or not remains to be seen.
Yeah, this is Don back here. A comment and a question. First of all, the comment. Tax Cuts and Jobs Act, of course, was debated in the media pretty extensively, and the Republicans are in power, and I think David Brooks commented that the one thing that unifies the Republican Party these days is that they're for tax cuts. So and in a two-party system, when we have one party, the Republicans being for a tax cut, the other party, the Democrats in this case, cannot say, I'm against a tax cut. They have to argue about who should be the beneficiaries of the tax cut. So that's what most of the discussion was about. The impact on the national debt was, I think, minimally discussed, and hardly anyone talked about the point that Tom made, which was that even without this $1.5 trillion or $1 trillion effective tax cut, that over the next decade our national debt was going to go up by another 10 trillion or so anyway, because we're running annual deficits now of about $1 trillion. So to put the Tax Cut and Jobs Act in context, it shouldn't have been considered to begin with by people like myself and like people on both sides of the aisle who are concerned about the national debt, who don't want to leave their kids and grandkids and great-grandkids with the debts that they have run up in their lifetime, having to leave their grandkids having to service that. So I guess my question is, it seems to me when you've got a situation like that, a political situation like that, where one party cannot come out against a tax cut if the other one is proposing it, you have to have a bipartisan coalition of responsible people to say, as they did at the end of the George H.W. Bush presidency, that, you know, these deficits are getting out of hand. We have to have a tax increase. We have to make changes, which of course brought about the deficits of the early Clinton first term. But I don't see that happening. Bipartisanship in Washington right now is in short supply, and fiscal responsibility is in short supply. PAYGO has gone out the window with this latest budget agreement in the Senate, you know, coming right after a massive tax cut. So my question is, what about a balanced, some kind of a balanced budget amendment to the Constitution, maybe with provisions or exceptions for war, maybe with provisions for exceptions for times of recession, or you know, protecting Social Security, however you want to do it. It seems to me that's the only way politicians would act responsibly, or is if they're forced to by a balanced budget amendment, and that would put the national government in the same situation that states are in. The state of Oregon has to balance its budget, and that's pretty painful at times, especially in, you know, times of recession. But anyhow, sorry about the long intro, but that's my question.
Well, Don, I was going to say until you made the last point that we should have dragged you out of the bookstore and put you in the economics department, or maybe the politics department, or maybe both. I don't think we want a balanced budget amendment myself, and Mark gave part of the reason, and of course you could modify your proposal, but his point was that we maybe might want to consider balancing it over the business cycle. That is, run surpluses when the economy is strong and run deficits when we need to give it a little bit of a boost from the demand side. But, you know, there's no guarantee that the down times are going to offset the up times, and it's pretty hard to know. I don't know how I'd write that. I'm sympathetic with your concern. Actually, when I was taking economics, and maybe Mark, although he's a lot younger than I am, we were sort of taught that debt is no big deal. We owe it to ourselves, and largely we did at that time. One, it was way smaller, as many of the tables that we put up here have shown. But we owed it to ourselves, and you know, we could, in theory, just run a huge tax one year and pay it all off. Nobody was proposing that, but there was, of course, now we know that the Chinese own a lot of the debt. The Japanese have owned a lot of it for a long time. I just don't. I'm sympathetic with what you're saying, but I don't think that we can quite. I don't think we would enact that anyway. I don't think that the Congress would probably vote for it. Mark, you have some thoughts?
Yeah, I just want to, one other brief comment about the debt. The focus often is, as Bob Muir mentioned, the Chinese will be holding more and more of our debt, and they'll have some political leverage on foreign policy and that sort of thing. Keep in mind, the largest holder of U.S. debt, if you look at the total amount, is held within the United States, and it's held by pension funds. So if the, obviously if the U.S. dollar and the economy goes bonkers, pension funds are not going to be very happy about it. But again, don't exaggerate the fear of foreign control of America, because overwhelmingly the debt is in our country.
Okay, this is Elaine Smith, and I have a question about capital gains. I'm not making any personal decision based on what I'm asking you, but I hear people, you know, over the last few years, they won't sell rental property or won't do certain things because the capital gains tax is so high. It's still less than personal income tax, but they make decisions to hold on to these things because of the tax. So is it this new tax bill, how does it deal with capital gains?
I don't know, but I do want to say one thing that that you bring up, and that's that people do behave differently under different tax regimes. And so we have to, and that's again, Ken, one of the reasons why it's going to be hard to predict what indeed is going to happen. Joan, on the other hand, said, well, I don't know anybody who does this because of a small change in taxes. So we really got different opinions as to how people will adjust their behavior. There is a concept called the flypaper theory of taxation, that it sticks where it's placed. And we didn't get into this, and you'll be grateful for us not doing it, because there would have been a lot of curves up there crossing and little triangles measured and so forth. But people do behave differently, and it impacts the consequences. As for your question, I'm not at all, I'm not sure what this act does to that. Maybe Mark knows.
I was trying to duck away from that.
All right, this is Evelyn. Would somebody define a pass-through business?
Well, first of all, let's talk about what a corporation is. A corporation is publicly traded, and they pay taxes as an entity. Pass-through corporations, pass-through businesses are everything else, and that just means that the income passes through to the owner. So let's say you've got a service station, and you make some profit, and you're not a corporation. Well, then you pay income tax, and the profit passed through to you. So the concept is pretty simple until you get into all the little intricacies. Does that help? So a sole proprietorship, a partnership, a limited liability corporation, all those things don't pay taxes as entities. The profits pass through and are paid by the individual.
A lot of franchises are pass-throughs. The mother company may be a corporation, but the actual owner of the franchise would be a pass-through, as Tom described it. So if you eat in a restaurant, inevitably that's an example of a pass-through, or a local filling station, or anything along those lines. And as Tom mentioned, it's surprising to most people, but there are many more examples of small business in the U.S. than there are of large corporations. And the structure of the American economy, in part, is responsible for that, and the changes over a long period of time. There was a time when manufacturing was a much bigger percentage of our total gross national product than it is now. What is it now, about 12, 15%, something like that?
I don't know.
Anybody know? But it's way down there. And increasingly we are consuming services. And they may be legal services, they may be healthcare services, they may be, going out to restaurants and all sorts of things like that. And that is a trend that probably will continue, but inevitably the focus is always on manufacturing. And that's part of the weakness of the whole approach in economic policy. You have to look at the whole picture.
Evelyn, I probably should have added that all pass-through businesses won't benefit from this 20% deduction. And for some reason, accountants don't benefit. They can't claim it. Lawyers can't claim it. So consultants can't claim it, but other people can. And again, I should have also added, well, I guess I did mention somewhere that a lot of people will seek to recharacterize their income as eligible for the pass-through. So let's say you work for a company and you're an employee. Well, if you could somehow become a business and contract with the company to do exactly the same thing you're doing now, but now you would be a business, you maybe, depending on how the IRS rules on this, you would be eligible for this pass-through provision, and you'd be able to save or deduct from your taxable income 20%. So it's, and as Mark said, I mean, I had no idea. I had no idea that 19 of 20 businesses were other than corporations. I didn't know that. And it's all happened in the past 35 years. So this again opens up still another opportunity for tax accountants and other bright people to figure out how they can minimize their tax bill. And again, that comes back to the idea of behavioral change. We're going to see a lot of behavior as a result of this new act. And Ken, nobody knows what it's going to be.
Sally Schreiber. Getting back to the Chinese investing in our country, we're probably the best place for them to put their money, which binds us together somewhat, and that's all, I guess.
That's right.
Thank you.
And it's great for the West Coast real estate market in both Canada and the U.S.
This is Jim. One thing that wasn't mentioned, it's kind of obvious, but those pass-throughs, the reason they're so attractive is that you can totally control that income, that so-called profit, either in investing in the business for future use or putting up in reserves, whatever you want to do with it. So if it looks like you've got too much income, you have ways of taking care of that with a pass-through.
Well, that helps me, because I was kind of trying to figure out, well, why is it that the pass-throughs have become so popular in recent years? And I really didn't know the answer to that. One, I didn't know that it had, and two, I didn't know the reason. But I'm sure that the 20% provision will add still another dimension to that.
Given the fact that we really can't control what the government does, and we appear to be approaching very hazardous times, what is the best way that individuals can protect themselves?
You can answer your way. Against what? I'd say hunker down.
Well, as Warren Buffett, I could just take Warren Buffett's comment, and that is think in the long term and don't do anything precipitous that is outside of your long-term plans, even though you're not getting the rate of return that you might have once received or would like to get. If you have a long-term retirement plan, long-term investment plan, whether it's working or not, stick with it until you do think it's not a good thing to have. And bear in mind, one of my basic rules of investing or responding to any policy changes is, by the time I find out, it's too late.
Hi, Roz here. My question has to do with the Federal Reserve. I would expect the Fed to increase interest rates to dampen down a growing economy, but my concern is that if the administration sees that as dampening the economy growing towards a 3 or 4% growth rate, which they've proposed, whether they would try to interfere with the Fed and its decisions. So my specific question is there any kind of legal firewall between the Fed and other parts of the executive branch, or have we just been lucky that politicians have kind of acknowledged the traditional independence of the Fed and not tried to interfere too much?
Well, let me take a crack at that, and then I'll turn it over to Tom. Basically, the Federal Reserve is independent of the government power, whether it is the Congress or whether it's the White House. Now, obviously, the White House has an impact on the Federal Reserve. For example, the appointment of the chair of the Federal Reserve System is the nomination is made by the president, and other kinds of nominations as well. So over time, yeah, outside of the Federal Reserve, there can be some influence wielded based upon who is appointed. But short term, the Fed was created in 1913, was it? 13, 14. 14, somewhere along that, to have an independent central bank and to have that entity to make decisions that are good for the country independent of the politicians. Whether they've succeeded over time is another thing, but I think it's pretty independent. Tom?
I don't really have anything to add, except that it does seem to me that the current administration is willing to give it a go if they think they can have an impact on whether it's the independence of the Justice Department or whatever else. And so it's not, to me, nuts to expect that, you know, if they don't like what the Fed is doing, that they're going to take whatever steps they can. But I don't know.
Well, I think we're out of time here, and so a big hand for Mark and Tom.